Hello viewers, in this video we'll be going over Gold Miners Jr. ETF ticker symbol GDXJ. In this video we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, and the day-by-day forecast for GDXJ. So back to the technical analysis. Today we're down roughly 3% on the 1 hour chart. We are now dipping into negative MACD and we are averaging lower lows. As the 4 hour chart, we are resting on our 50 moving average. However, we may approach to negative MACD very soon. If we expand out further to the daily chart, we are now positive on the daily MACD, and we failed to break above the 200-day moving average, this green line, and we failed to close above it several days already, and we may average down lower to test support. I do see a possible support around the 18-day moving average, this purple line. That coincides with past resistance, and since we're above resistance, that now acts as our support. So that is around a price of $33.64. And as for, let's say, resistance, if we do manage to head up higher, and we may encounter resistance that was made back in April 14th, at around a price of $41.33, and that also coincides with past resistance back in March 5th, and yeah, we may encounter resistance very soon, and if we do manage to fall lower, that price movement is roughly around 8.4% to head back to the 18-day moving average, and if we reverse and continue to head up higher, that price movement is roughly around 11.8% to next resistance. So let's head to the day-by-day probability model. As the days progress to the 7th day, we have a 35% chance for gold miners to climb higher between 0 to 12%. On the extreme case, we have a 24% chance for gold miners to climb between 12% to 24%. And on the other hand, we have a 41% chance for gold miners to fall between 0 to negative 12%. Again, this model is now available in the link below, so do check it out. So let's head to the day-by-day forecast for GDXJ. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend. Right here we have the current trend on the line graph, and overlapping it is the trend that I believe is the best match, and let me try and find it. It is September 16, 2014 to December 10, 2014. That is best match, I believe, is the best match to the current trend. So we have the current trend right here, and below it's the trend that I believe is the best match. And let's compare the two trends. So what we have here, we start off at the bottom Bollinger Band. We see an intent to revert back to the mean at the middle Bollinger Band, and then we proceeded to once more hit the bottom Bollinger Band. And after touching the bottom Bollinger Band twice, we see it reverse and head up to touch the upper Bollinger Band. So now the trend in question, we start to see a similar pattern here as well. Well, let's just mark the end result, and at the end we touch the upper Bollinger Band and we touch the bottom Bollinger Band. Before that, next we mark the instances where we touch the bottom Bollinger Bands. We have our first one there, and between those two instances where we touched the bottom Bollinger Band, we did revert back to the mean to touch the middle Bollinger Band. So what we have here is 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was September 16 to December 10, 2014. Back then, gold miners was down roughly around 5.3%. And if we head back to the day-by-day probability model, that coincides with this standard deviation between 0 to negative 12%. We have a 41% chance to hit this standard deviation. So let's examine the technical performance of each model. So our current model that we're in is down 22% from monthly high, up 40% from monthly low, up 4.1% from 10 simple moving average, up 10% from 20 simple moving average, and up 4% from 50 simple moving average. So the trend that we just examined was September 16th to December 10th, 2014. It was down roughly around 50% from monthly high, up 10% from monthly low, down 3% from 10 simple moving average, down 6% from 20 simple moving average, and down 12% from 50 simple moving average. We do see a technical difference in between the 50-day moving average, 20-day moving average, as well as the 10-day moving average. And on the monthly high is different. This was 50% from monthly high, and we're much closer to monthly high compared to on the current trend. And we are also much higher away from the monthly low than it was back in September 2014 to December 2014. So there is a difference in the technical performance of both models. Again, this model is now available in the link below, so do check it out. If you enjoyed this content, feel free to like, comment, subscribe, and thank you for watching.